What are investment banks? By the end of this video, we will have a clear understanding of what investment banks are, the functions they perform, and the significance they have in the financials market. So we are going to discuss 5 major functions that investment banks perform. Number 1 is that they make the sell side of the market. The entire market is divided into the sell side and the buy side. And I'll get to that in a minute. So for example, a company wants to raise capital, right? Because they want more money to expand their business. Now they can do that by either having more debt and issuing bonds, or selling a part of their equity and issuing more stocks. Now when they want to do this, they will go to an investment bank. And investment bank is the entity which will help get the entire work done. So what is the thing that is needed to raise capital by issuing bonds or equity or stocks, right? So step number 1 is to prepare a prospectus. A prospectus is, you could say, a brochure which contains all the necessary information as to where the money will be used, right? Because there are investors who are putting their life savings into a particular company. So the prospectus makes clear where exactly the money will be used, what the opportunities are for the company, what the threats are for the company, and what dividend or what return on their capital they can expect. So it is the investment bank which actually prepares the prospectus for the company. The second step is to actually issue the stock or to actually issue the bond. So the investment bank actually remodels the entire capital structure of the company. And this is actually where the product creation, the financial product creation and origination comes into place, right? So the investment bank actually remodels the financial structure of the company and issues those new bonds or new stocks. And once they have issued the stock, it is now their responsibility to sell those bonds or to sell those stocks to the buy side, because they're the sell side, right? They're originating a product and they're selling it to the buy side. Now, who's the buy side? The buy side are people who are going to put the money into the hands of the investment bank and take these newly issued stocks from them. So the buy side can be mutual funds, they can be hedge funds, they can be pension funds, they can be high net worth individuals, these could be insurance companies. Anyone who wants to invest money in the securities can be the buy side. So the investment bank will sell, because they are the sell side, they will sell these newly issued bonds and stocks which they themselves created for the company. They will sell it to the buy side, right? And there are 2 ways they can sell this. Either they will underwrite it. By underwriting it, what they do is they buy all the stocks and they buy all the bonds from the company. So they own it before they sell it to someone else. So they buy the stocks at a discount and then they sell it at a profit to the stock exchange, right? But while doing this, they take a lot of risk, right? Because if they are able to sell all the stocks, it's great. It's called an oversubscribed IPO or initial public offering, where the private company who raised stocks just went public, right? Or if no one wants to buy those stocks, that could be an undersubscribed IPO, and the investment bank will end up with stocks that no one wants to buy. So the other option is that they become agents, okay, who sell on behalf of the company. So that was function number 1. They sell, they originate, they create financial products like stocks and bonds, and they sell it to the buy side. That was the first thing. The second important function is acquisitions and mergers. So when a bigger company wants to enter a new market, instead of starting from scratch, they buy the competition. They buy the smaller companies that are there in the new segment. So to buy those companies is called acquisition. So they buy all the outstanding shares of that company, or at least the majority of the shares, and so they have a controlling power over that company. So investment banks help bigger companies acquire smaller companies. And then there are mergers. What are mergers? Well, mergers, when two different companies want to become one by combining their strengths, by combining their capital, by combining their resources, their intellectual resources. Okay, so when two companies become one company, that is called a merger. That is called a merger. So investment bank helps in two companies merging together and becoming a bigger company. The third function that we're going to talk about is designing, packaging, and selling financial products. So just as in our first example, we saw that investment banks help the company issue new bonds and new stocks. So just like there are bonds and stocks, there are other financial products like options and other derivatives and other hedging instruments, so on and so forth. So it is investment banks which actually design and originate and create and sell these financial products for the benefit of the companies. Now, the fourth is privatization, which is the opposite of IPO, right? In our first example, a private company went public by issuing new stocks, right? With an IPO or an initial public offering. Now, if the same company which went from being private to public, if they want to become private again, they have to buy back all the outstanding shares. This process is called privatization. So investment banks help in privatization as well. Now we come to the fifth point, is that they help in advising the big players. So just like a normal common man will usually take help of people who know about finance, people who know about business, maybe a personal financial advisor to help in financial decisions, when to what to do with your student loan, if you should take any in the first place, how to manage your how to manage your personal finance, and these personal financial decisions a common man takes with the help of their family and friends. The big companies, the multi-billion-dollar companies, they take the advice and they take the help of investment banks, and investment banks help them as to how to move forward with their financial strategy, how to raise capital, and whether they should acquire new companies, whether they should merge with other companies, what are the hedging risks, what are the costs, etc., etc. So these are like the 5 main functions that an investment bank provides. So you can say that investment bank is like one of the backbones or one of the pillars of a capitalistic society, because it helps in the transfer of funds from investors to savers. It helps companies raise capital. It helps investors invest their money. It helps various kinds of financial instruments to come into existence in the first place. So this is it for this video. Just to recap, the 5 functions we discussed is that they are the sell side and they help companies raise capital by bonds or by issuing stocks. Number 2 was acquisitions and mergers. Number 3 was designing, packaging, and selling new products. Number 4 was privatization. And number 5 was advising the big players. So this is it for this video, and I'll see you in the next one. Assalamu alaikum.